We'll be speaking to Mr. Arvind Nanda, the MD of Interarch Builders, on the back of the Q1 results that they reported yesterday. Now, the results were, a decent set of numbers while margins, stood up. Revenue growth was slightly lower. To know more about Q1 as well as, the company a bit more after their first quarter results post-listing, we are now joined by Mr. Arvind Nanda. Good afternoon, sir, and thank you so much for joining us today. Firstly, many congratulations on a very successful listing. I wanted to start with, before coming to Q1, you mentioned that, this is the first, quarter since post your listing. So just for the benefit of our viewers, if you could tell us about what Interarch Builders is into, the segment that you guys are operating in. I believe you qualify yourself as a pre-engineered building solution provider, but just if you could, in short, just tell us about the company.
Thank you for having me on the show. Very briefly, pre-engineered building product is something when a customer wants a factory or an industrial building or a warehouse or any other building, he would come to us and say, okay, this is my requirement. We convert his whole requirement with our engineering department and design department and sales working together to make it into a building for him. Once we get the order, then we make the whole building in our plant. The whole building, every part of it is manufactured from a plate as a raw material or coil into a building, column, beams, everything is made in our plant, taken to site in pieces and assembled there like a mechano set. So it's like a product. You have one building, one price, one completion date for the customer. So that is what the customers want, that a building has become a product and the building to suit their production requirement, process requirements, everything is taken care into. So we classify ourselves as a primary capital goods supplier to a customer. All our customers are world-class names, world-class Indian names, multinationals, warehousing funds, everybody into the new sectors. They were just talking in the previous show about renewables. And so we are working with every company doing renewables, whether it's batteries, whether it is solar, cells, in all these sectors, data centers. So we can do any building just like any capital goods supplier can make. But we have one more advantage over any capital goods supplier is that we are industry agnostic. So any industry which is growing, automobile, FMCG, warehousing, any new industry comes in, like data centers are coming in now in a big way, we can work with them. So that is in a sort of a nutshell, a pre-engineered building. One price, one date of completion.
Thanks for that, Mr. Nanda. Now, just wanted to talk a bit about Q1. Now, you had margins have stayed around the 8 to 9% range, but revenue growth was slightly slower. Now, I'm guessing this was because of general elections as well as heat waves in this particular quarter. Was that the particular reason? And how is Q2 shaping up? Because this is also a monsoon quarter, not very good for capital goods companies. Just wanted your understanding on the same.
As an industry, we are more for a half-year industry. We are seasonal in that sense that we have to be viewed half year because like you rightly mentioned, this year elections also came in, but because of monsoons and the heat waves and this thing, while we have a full order book, while we are doing full production, we are not able to dispatch a lot of the goods if the site is not clear. Sometimes it's flooded, sometimes there's heavy monsoon, sometimes labor cannot work because of heat or safety condition. So there can be a lot of variation between these two in the sales. So naturally, of course, it affects the margin also. So this year, the first quarter has been better than the first quarter of the last year. Anyway, we cannot go quarter by quarter because every year our quarters start again. 1, 2, 3, 4, they'll all be better than the other. Last year, we had more sales in the first quarter and more margin than the second quarter. Second quarter was less by nearly 20-25%. This year, we are expecting it to be, the second quarter to be far better. It's nearly over now. Our second quarter is going to be far better than our first quarter. So as a whole year, we normally do about 45% of our business and margin in the first half and 55% in the second half. That has been like long-term trend as we see it. And we are well on our way to achieve that trend for our projected turnover of between 14 to 1500 crores. So while the revenue is up, we are very happy with it. In fact, in spite of the elections and labor not being available and site clearances and monsoon, but between the two quarters, we finish everything that is required to be done. That doesn't get delayed. So while revenue is up, in fact, previous year it was down. First quarter was much lower than the second quarter. So we are very excited that we still managed to achieve our turnover targets and our profitability targets much better. And we are well on our way to give the projected targets, achieve them.
Well, thanks for giving us the guidance, roughly 1400 or 1500 odd crores. Now, you were close to 1300 odd crores last year, but before I come to full year guidance, I just wanted to understand, you are present in a few segments specifically that you've called out in your presentation as well as your RHP at the time of IPO filing. So apart from steel constructions, you are also into a high rib roof as well as the cladding systems. Another is metal roofing. So if you could just talk to us about Q1 specifically, what is the split, or if you want to talk about FY24 historical numbers, which segment is the biggest one? Is it the steel construction that is the biggest segment, and is the margins very different across these particular segments?
We are primarily a pre-engineered building solution provider. All the other items now fit into that. Historically, because we started in false ceilings and then moved on to roofing and claddings and then pre-engineered buildings, so it is we still sell them separately also. But gradually that sale is minuscule now compared to our total turnover. But all our items get used in the pre-engineered buildings. So pre-engineered building is primarily the major item, and the margins are pretty spread out and stable throughout the sale of pre-engineered buildings. The other ones are pretty minuscule now.
So would it be safe to assume that roughly 80 or 90% of your revenue will be coming from the steel, pre-engineered steel buildings?
About 95%.
Understood, sir. Now, just wanted to take the conversation forward on your new factory that you've inaugurated now. Now, this is coming up in Andhra Pradesh. You've invested roughly about 95 odd crores. Talk to us about the scope and what's different about this factory. Is it going to help you, in your capacity utilization as well as enter new geographies as well? Just wanted to understand a bit more on that.
In our business, once we reach about 80% of our capacity utilization, which we have achieved in the other three integrated plants, even though this is the fifth, but it's the fourth fully integrated plant being set up. So 3 integrated plants are giving us a turnover in buildings at current prices of about 15 to 1600 crores. So we have achieved about 80% of that in the last year. That is why we started the new plant in the end of last year in October, November. And we hope the first phase is of course complete. Second phase will be complete by February. That will be also adding another 550 crores of buildings into our turnover starting from February next year. So we would have about 2000 to 2100 crores of capacity of buildings by February, March, which is currently about 1700. And I think that is on target, to achieve our production so that we can get those kind of orders, because the orders are there plentiful in the market. All these sectors that we deal with are doing very, very well. We have a top of the mind preference among the customers as the number one pre-engineered building company in terms of preference of mind. A lot of top companies come back, but we need to build up these capacities so that we can take advantage of that. And then, of course, we have booked land in Gujarat, which will be our fifth fully integrated plant. In Gujarat, we are also thinking of adding heavier structure. What we do in pre-engineered buildings are considered like lighter structure, even though they are huge buildings, but each piece is very light. So we are also planning to get into heavier structures, which can go into power stations, steel plants, port buildings, railway stations, and these kind of high-rise buildings, data centers. We have done a data center already, but to make it more viable going forward, we want to have to get into heavier structures, which will happen in Gujarat. So currently, we are well on our way to build up capacity to achieve our turnover. Our long-term projection is that within 3 to 3.5 years, we should double our turnover.
Well, that's really great to hear. So just one follow-up question now. For specifically, you mentioned that, roughly around 2200 odd crores of capacity you will have, 2200 odd crore revenue capacity once your, facility comes on stream in February. So effectively, we'll see the whole scope of that coming into next financial year. Generally, do you see the trend being around 15 to 20% growth for you? And as you mentioned that, you'll double in the next 3 years. What does that do for margins as well?
Margins go up because we are a very heavy operating leverage kind of a company. We have a certain amount of fixed expenses, which is a very huge people expense, because being engineering, sales and execution company also besides the plant, we need to build up that resource very strongly with the best people literally available in the world. We have to sort of get the best people to be able to deal with the best companies in India. But operating leverage is very high. Once we have built up that, which we did that lot last year, now the plants are coming in. So we are very confident that the EBITDA margins will go up more than what they were last year. That we have given in our projections also. I mean, it could be a huge jump. We really don't know. I mean, sometimes in this industry, we are also building up, getting better margins from customers because we do a great job. We do give a great product to our company clients. So we are very hopeful that going forward, as the economy is doing, our own positioning in the market is very good. We are top of the mind of nearly every client, whether it's a foreign company, Indian company. In the past, we have worked with Reliance Solar, Excite Batteries, First Solar, Renew Power, a data center for Iron Mountain, which is an American company. We work with all the funds which are top A grade warehousing funds like Indospace, Wellspun, Logos, ESR. So we are at the top of the mind for everybody. A lot depends on how much can we generate our own capacity to go up and fulfill the requirement, because the order book period to execute the orders is very short in this business. A large order can also, have to be executed in 9 to 12 months. Nobody really has any orders longer than that. So we need to build up that whole capacity, which we are trying very hard because the business is there. Business is not in short supply. And we are right there in the top of the customers. In fact, we are in a bit of a fix because a lot of our customers want to give us more business, but we are committed to deliveries and quality and safety. So we are in a little fix right now. But I think going forward, we should be able to cover that.
So just this one follow-up question. So your order book is roughly around 1,350 odd crores as per your latest filing. So is it safe to assume that this will be executed over the next 12 to 18 months at the max? And if you could just talk to us about the competition as well, because definitely not in the listed space is someone as close to you in terms of business, but what is the current competition? Because you mentioned that, capital goods companies who are, you will be the first port company to come in case they are, doing any kind of projects for your steel buildings. In case they don't want to go with something similar to your business, what would they choose instead? That's my just one question on this, sir.
Yeah, the order book is normally executed within 9 to 12 months max. So I think we should be able to execute our 90% of order book. Sometimes 8-10% orders do go on hold or stop or get delayed. But assuming that 85 to 90% orders, which we have, our order means order with advance and all clearances. But that we have to finish in the next 9 to 10 months. We can't delay it any more than that. So we are, of course, going to take more orders to going forward. Second is competition. See, immediate competition is with a Kuwaiti company, Kirby. They have been in India for nearly as long as we have been in pre-engineered buildings, over 23, 24 years. Excellent company, world class, and we love competing with them. We have built up our company to be able to compete with them. It took us a long time because they are world class and they are all over the world. They've got world class engineering and production facility. So invariably we compete with them. I think we are now reached a level where a lot of the customers put us equally. Maybe Kirby won't agree if they're listening to this, but they have put us equally, and we are doing a lot of projects, a lot of the big projects. Other competition, see, in steel, a lot of the industrial buildings and a lot of the warehousing buildings have to be done in steel. There's no competition from concrete and cement in those buildings. But earlier, they used to be fabricated at site. A customer would get a consultant who would give him a design, give him what sections are required, then he would go and buy the sections from the steel supplier like JSW or Tata Steel. Then he would find a contractor who would fabricate the whole building for him at site.
Right.
And then erect it, and then maybe get a roofing and wall cladding separately supplier. So all that has been combined into one stop now. We take the full responsibility that we are one building, one price, one completion date. Right. Every part of that building ground upward is done by us. So that's a big change. So we don't face much competition from fabricators in this sector of the market. Yeah. But yes, there is other competition in pre-engineered building, as they will be in such a lucrative and a fast-growing sector.
Well, Mr. Nanda, thank you so much for talking to us today. Really interesting business model that you have. You're modernizing the industry, as you mentioned, and, strong guidance also for the next year. So thank you so much for joining us today. We look forward to our next conversation and understand a bit more about the business. But thank you so much for giving us so detailed answers and so candidly as well.